We are witnessing a time in which central banks have been printing less money. They have been slowly trying to lift their feet off of the gas and attempt to keep the stock market afloat. Will they be able to do this without setting off the global economic collapse? You came here for the truth, so let me unveil that for you. Today we're going to look at several indicators showing us that we are in some very, very tough times. Look at this here as the central banks have been printing less money. I'm going to show you a few charts on this topic specifically. They still have trillions of dollars that have been out there trying to circulate through, but now the central bank have decided that they are going to rein that in. They are still, of course, printing globally. That's an absolute fact, but there's less of it happening. And because of that, you need to remember that as time goes on, the markets require more and more to get less out. That's because of the devaluation of the currencies over time. You can see the year-over-year changes in global QE. Look at this, whether it's the Fed, BOJ, the ECB, China, doesn't matter. You will see that they have been definitely on a downward trend in how much money they're printing. The Federal Reserve is actually tapering slightly. The Bank of Japan is tapering ever so slightly as well. Monthly change in the global QE also down. You can see that for yourself in this chart. Now, taking a look at the G3 central bank balance sheet, that's the lighter blue color, compared with the global financial stress indicator. Now, as this has come over the hump and has declined downward, we have witnessed this to become an issue on many levels. This here is just one indicator, but I thought it was important to see how the tapering off would affect markets globally. South Korean export growth, a great lead of global earnings per share, just turned negative. So that usually, based on this history here, very, very accurately predicts a downturn. And we just hit that right here. So could earnings per share also decline? Well, we'll have to see for ourselves. If the central banks are not willing to print and buybacks perhaps would decrease, then certainly we can see this come down as well. More than a dozen of the world's biggest banks have slipped into a bear market, highlighting risks to the global economy, even as equity indices reach new highs. So with the Federal Reserve increasing interest rates, obviously this puts a further burden upon these companies, particularly the financial institutions. They are the prime focus when it comes to raising interest rates. All right. Among 39 of these big banks, financial institutions that are considered systematically important, 16 are down more than 20% from their recent peaks in dollar terms. 20% is a definite bear market, the beginning of one, of course. They could turn around tomorrow and things could definitely change, but not without central banks printing more money. They include names such as Deutsche Bank and many others you'll see here on this list, but this is one that clearly is really front running all of these problems. Looking at this in a chart form might be hard to see in this chart, but essentially the S&P 500 is that blue line, and you could see that these systematically important financial institutions, they overreached the S&P and now have gone down below it. So that's what always happens. It's always an overreaction on the upswing and on the down. That's something important to note from this chart. Moving on to look at this specifically, it's a little messy on this chart here, but you can see clearly that these institutions have been declining since January approximately. We have seen these coming downward and they have not really let up in that. Some have done worse than others, that's clear. But what I'm seeing is that there are, the general total of these, whether it's here on this chart, JP Morgan, Goldman Sachs, and others, they've been declining. And you're seeing this as a big trend here, not just in the US, but of course, all over the place. The CDSs of these corporations are becoming something that we need to watch out for. As these increase, that's showing us where the risk is, where the fragility is. The CDS is trying to price that in, but of course it's used as a weapon against these companies too. So that is something that we saw during the financial crisis last time around. Take a look at this here. Again, as the stocks started to fall, the CDSs started to climb. Credit default swaps, for those who don't know. All right, we have mergers and acquisitions that always go and hit a peak right at the time we have a crash, and then everything comes tumbling down. This time around, they're asking the question, has the current merger wave peaked? Well, we'll see, of course, only in the pages of history, but we can definitely say that we are in that territory at this time. It gives us an interesting perspective where we could head. We could see how much these have really played a role in what's happening today. Companies have been buying each other out now at the scales we've never seen before. It's massive on every single level. I thought this was something interesting to show you here. And then just want to touch on two more points. I've shown you this chart before, but I thought it was just a good lead-in for this one. Non-financial corporate debt to GDP ratio. Taking a look at this being a leading indicator of recessions as well. And then this. Many people aren't concerned because we have the plunge protection team, because we have the central banks willing to do whatever it takes, as Draghi said, to instill security and safety in the markets. But if they are not printing more money and they're decreasing the amount and they're tapering off their balance sheets, then they're not really willing to do whatever it takes. Will they reverse course? Perhaps, but they say they won't. So every time you can see that the market starts to decline, whether it's in a day or in a week sometimes, they find a way at the last moment to bring it up, to ensure that before the close of that day or that week, everything looks just fine. And the VIX, have no fear, will continue to defy all logic. Even though the VIX should be on a daily basis moving up and down like it's nobody's business, it's quite calm. Well, I'll end it there. If you found this video informative, I would really appreciate a thumbs up because that helps to support this channel. And I really do thank all of those who do that every time. And if you found this video informative, then you definitely want to check out these books. This is the financial education you were not taught in schools, and I squeezed it down into two very easy to read books. They fit into each other like puzzle pieces, so they cover information that's technically related, but I fill in the blanks for each other. So if you want to check these books out for yourself, you can do so at Amazon. There's a link in the description of this video. And if you prefer the audiobook version, you can get that at themoneygps.com.